Now, you're going to have suitability questions on this test. There's no getting around it, and they're not black and white. They're kind of gray. So how in the world am I supposed to tell you how to make a decision for something it's just not, there's not a perfect box to put it into. So I've been doing this for many moons, and what I have found over the years is that the very best way for you to answer suitability questions is for each and every suitability question. You have to, number one, look for what is the client's investment objective. So that's the number one determining factor in what is it that you're going to recommend to the client. What is their investment objective? And then number two, out of the choices that are given to you, so it's a multiple choice test. So generally there's 4 choices. Make a risk spectrum. Plot them out on the risk spectrum. So what we're going to do is we're going to make a hypothetical risk spectrum. This is not perfect. It's different slightly every time I make it because I might think of something new the next time I make it. But it really is helpful, since you have to make these suitability decisions, that you're comfortable with classifying different types of securities and where they belong on a risk spectrum. So I know I told you that your homework was to read a prospectus from a mutual fund that you're going to be recommending. Most mutual funds, they have a whole family. Let's say there's 20 different mutual funds. Somewhere in their advertisement, they have a risk spectrum that takes everything and plots it on here from low risk, low reward, so low yield, to high risk. So the whole family will be plotted on a risk spectrum. Look at it. High risk, high reward. You might make a lot, you might lose a lot on the right side. You're not going to make as much, but you're not going to lose hardly anything on the low side. And then in the middle, I'm going to put a balanced fund to start us off. Balanced. So what happens usually when you have a question that feels like, I don't know which one of these is the right answer? You make a risk spectrum, and there's usually going to be something that is on the riskier side of balanced. And then there's going to be something that's very conservative. And then there's going to be 2 that are kind of in the middle. And it's your job to pick which one is the best. If one of those choices is muni bonds, I need you to look in that question. And if that question, it doesn't say anything about tax bracket, the muni bond answer is not correct. So if you plot it out and you think, that's really conservative, that's really aggressive, muni bonds are for a high tax bracket, there's your answer. Granted, there's, 1,000 different permeations of how they might ask this question, but I really believe in the risk spectrum. It helps you tremendously. It gives you a tool to answer these questions that, historically speaking, from feedback from students, can be challenging because they're asking you to make a judgment call. But isn't that what you're going to be doing anyway? As an investment advisor representative, what you're going to be doing is making recommendations that are in the best interest of your client. So it's fair that they ask these on the test. So on the low risk side of things, we would have cash. There's no risk in having cash except for what? If you take your cash and you put it underneath your mattress, don't tell me where you live, you've got inflationary risk. Because the $100 you stuck underneath your mattress when you find it in 20 years, it's still going to be $100, but it won't have kept pace with inflation. So inflationary risk. If we were talking about treasuries, which is the one that's as close to cash as you can get? T-bills. Treasury bills. Safe. Tips, treasury inflation protected securities, those are safe as well. So safe side, money market instruments as a whole, money market instruments. Bankers' acceptances, negotiable CDs, and commercial paper. Getting a little tiny bit riskier, we would have treasury notes. And then we would have treasury bonds. And then we would have munis. And after that, corporate bonds. So just gets us something to work with, something to go on to answer these questions. So to the left of balanced, we have debt instruments, fixed income securities to the left of balanced. To the right of balanced, we have equities. So kind of this happens. We have these very safe things and a few that are kind of getting, not super risky, but riskier. And then we're going to have a whole bunch of really risky things and then some that are in the middle. So if I said index fund, where's it go? What are you thinking? You're thinking, what kind of an index is she talking about? Because there's lots of different types of index. So the Dow Jones Industrial Average is the narrowest index we ever talk about. The Wilshire 5000 is the broadest. So exactly where an index fund goes, I'm not sure unless I knew exactly which index it was that you were talking about. The Russell 2000 is small cap company stock. Do you need to know that? Yes. Or I wouldn't say it. So, but I can tell you this. Commonly, when I ask this of my students, where does an index fund go? They feel like it's safe, and that is wrong. An index fund is definitely going to be to the right of balanced. An index fund. Because what is in the portfolio of an index fund is equities. It's all stocks. And then exactly where it goes really does depend upon the index. What about a growth and income fund? What do you think might be in a growth and income fund? Some stocks, that's the portion that would represent growth, and some bonds. Preferred stocks as well for the income. So growth and income fund, there's a lot of mutual funds that have growth and income funds. I'm just going to put that one here, a little bit to the right of balance, but it could be right under balanced as well. Growth and income fund. If we had two choices, a large cap fund or a small cap fund, which one would be closer to the very riskiest side of the board? The small cap fund. So the smaller the capitalization of the companies that the fund is invested in, the higher the risk. So I'll put large cap fund. Large cap funds are safer than small cap funds. Don't go telling your clients that any of this is safe. Don't say it. But I do say it in reference to certain things throughout the course. Don't say securities are ever safe. You may lose every dollar that you have invested. That's always the case. But just to get us to understanding that we need to be at for the test. Ooh, I want to invest in those emerging marketplaces. Brazil, Russia, India, China, and Korea. That's what I want. Where would that be? Emerging markets? Ooh, hot over here. Emerging markets. You could make a lot of money here for sure. You could lose a lot of money investing in emerging markets. Another one that's on the riskiest side of things are precious metals. Precious metals funds. Incredibly volatile. I don't know if you've been following gold or following silver. Precious metals market price is incredible. These are commodities, incredibly volatile. Limited partnerships would also be over there on the risky side of life. We know that if you buy shares of a limited partnership, the shares are securities, by the way. They're usually sold through Regulation D, so they're unregistered, non-exempt, but they are securities. Limited partnerships are risky. You can make a lot of money, you can lose a lot of money. No secondary market. And sector funds. Maybe you believe in the pharmaceutical sector, so you put all of your money into a sector fund. That would have high risk as well. Now, you might find within the family of funds that your fund has different titles for different things. That's very common. Oh, you can think of some famous mutual funds and some of their names over the years, of which, without reading the prospectus, you're not really sure what it is that they invest in. So the test doesn't ask about any of those kinds of funds. They ask about funds that are generically named, if you will. I know one that I want to put up here, if I could find somewhere to put it. Let's see. I want you to tell me the difference between an international fund and a global fund. So an international mutual fund and a global fund. Which one would own stocks of companies that are worldwide? So including domestic stock, as well as international. The international fund or the global fund? The global fund would own stocks of companies both domestic and international, where an international mutual fund would only own shares of stock of companies that are outside of the United States. So which of those two, international or global, would have higher risk? I would say international would have higher risk. They're both risky. International would be higher risk, however. International fund would just be outside of the U.S., where the global fund would include all of the potential companies, or it could include both domestic and international companies' stocks. So that list, it's not exhaustive, but it gives us a starting point, something to work with when we answer these suitability questions. I expect you will do really well on them now. I expect you will have a couple of questions on capital market theory. Not in detail, but just general questions about some of these various theories. We start off with the capital asset pricing model. This model was introduced by Jack Traynor, William Sharp, John Littner, and Jan Mawson in 1962. It built on the earlier work of Harry Markowitz on diversification and modern portfolio theory. The capital asset pricing model is used to determine the required rate of return of an asset if it is going to be added to an already diversified portfolio, giving that specific asset's non-diversifiable risk. The capital asset pricing model will consider the asset's sensitivity to market risk, systematic risk, non-diversifiable risk, which we call the stock's beta factor. This model also looks at the expected return of the market as well as the expected return of a risk-free asset. We know the risk-free asset is the rate of return on a treasury bill. The capital asset pricing model may be used to determine expected return. So that's the test question. The capital asset pricing model may be used to determine expected return. Harry Markowitz introduced modern portfolio theory in an article in 1952. The driving concept behind modern portfolio theory is the idea that the assets in a portfolio should not be chosen based upon their individual attributes, but instead it is important to consider how each asset in the portfolio changes in price relative to the other assets in the portfolio. It is the idea that in a normal economy, in a normal marketplace, if bond prices have moved down, stock prices have moved up, that they move inversely related to each other, so that having both securities in a portfolio will reduce the portfolio's overall risk. Modern portfolio theory assumes that investors are risk-averse and that they would like the highest yield at the lowest risk. So that is an assumption of modern portfolio theory. It also assumes that investors are rational and markets are efficient, which is a point of contention for many of the opponents of modern portfolio theory. Modern portfolio theory is a form of diversification. Under certain assumptions and for specific quantitative definitions of risk and return, modern portfolio theory explains how to find the best possible diversification strategy. It is modern portfolio theory that led to the changes in the prudent man rules. Now, trustees of a trust are held to what we call prudent investor standards, reflective of modern portfolio theory. And we will discuss the prudent investor standards in just a little while. You need to have an understanding of the basics behind what is called the efficient market hypothesis. This theory is the work of Professor Eugene Fama, and it was introduced at the University of Chicago in the 60s. The efficient market hypothesis states that everything to be known about a security can easily be known today, and that the market prices are reflective upon this known information. Efficient market hypothesis is the theory that states that it is impossible to outperform the market except by luck. The efficient market hypothesis states that no one person has an advantage in predicting future stock prices because no one has access to information that is not readily available to everyone else. The hypothesis is that markets are efficient, hence efficient market hypothesis. Under this hypothesis, no planned approach to investment will be successful. Efficient markets hypothesis argues for putting all of your money into an index fund, and that while there might be a January effect, the transaction cost associated with trying to time the market make the ability to profit from something like the January effect next to impossible. You do need to have a basic understanding of the three forms of the efficient market hypothesis. So there are three forms. I expect one of these will probably be a test question. There's the weak form, the semi-strong form, and the strong form. In the weak form of the efficient markets hypothesis, it says that future prices cannot be predicted by analyzing prices from the past. Okay, let's stop for a second. Quantitative analysts, that's what they want to do. They want to use the past to predict the future. So this weak form, it's called a soft form. It believes that prices follow a random walk and that excess returns cannot be earned in the long run by using technical analysis based upon historical data. This form believes that fundamental analysis, so reading the financials, may allow for excess returns. So the weak form says the quants, they're never going to win. Fundamentally, you might make a little bit of extra money. Weak form efficiency implies that the future price movements are determined by forces that exist outside of the price series, outside of the historical data in the market price. So that's what we call the weak form. So the question isn't which one's right or wrong. It's just a matter of what are they saying? What is their efficiency? The semi-strong form. In the semi-strong form efficiency, it is believed that share prices adjust to publicly available information very rapidly, such that no excess returns can be earned by trading on that information. Semi-strong form efficiency implies that neither fundamental nor technical analysis will be able to produce excess returns. So it says nobody, not the quants, not the qualitative analysts, can provide excess returns. The strong form. In strong form efficiency, share prices reflect all information, both public and private, and no one can earn extra returns. In its strongest form, not even insider information could give an investor an advantage. So if the test question was to be something like, what describes the fact that the market price of the stock is reflective of insider information? Okay, bizarre question. Which one of these three, weak, semi-strong, or strong form, says that the market price is reflective of everything, even insider information, and even an insider can't profit? Which one? The strong form efficiency of the efficient market hypothesis. So some people agree with efficient market hypothesis and some people don't. Warren Buffett is a huge opponent of efficient market hypothesis. He's been well known for beating the market over many years by focusing on fundamental analysis. It's important to have a basic understanding of how each of these various capital markets theories works, what they were designed to do. You might have a question on each of them. I would say maybe 3 total in this area. There are opponents and proponents to each theory. So the test is never about which one is right or wrong. Other investment theories. There is the Monte Carlo simulation, which is an analytical technique in which a large number of simulations are run using random quantities for uncertain variables, and then looking at the distributions of the results to infer which values are most likely. It's like gambling. It's called Monte Carlo. So it's a kind of gambling philosophy. Contrarian. I mentioned this earlier. It is incredibly probable that if the stock market is down 20%, all of your customers are going to call you up and they're going to be freaking out and they're going to want to sell. But that's not right. You have to explain to them that we want to be contrary to what the odd lot investor does. We want to, when the market is going down like that, we want to buy. And when the market's up and your clients call you up and they want to buy because everything's up so high, you're supposed to explain to them that they're backwards and the contrarian is going to sell. So the contrarian investment philosophy. Whole entire mutual funds are built upon doing the opposite of the odd lot investor because the odd lot investor does the wrong thing. The dividend discount model is a mathematical model that discounts future expected dividend payments to determine if they are included within the current market price of the stock. And if they're not, well, then that stock is a good buy. So it's called the dividend discount model. The barbell investment strategy. This is a strategy for managing a portfolio of bonds. So think of a barbell. If I had a barbell, you'd have bonds that mature in the short run on one end of the barbell, nothing in the middle. You'd have bonds that mature in the long run on the other end of the barbell. And you're actively managing as these long-term bonds get towards the middle, you got to sell them and buy new long-term bonds. So the barbell investment strategy is an active management strategy for managing a portfolio of bonds. Other strategies include the buy and hold. There's this thing that happens with the market is that it goes up and up and over and over and down and down and up and up and up and over and down and down and down and up and up and up and up. Over time, the market has always gone up. So if you engage in fundamental analysis and you buy stocks based upon some research, but once you buy them, you don't try to actively trade them. You just keep them for as long as you can. This is passive, to buy and hold. When you're passive, you don't incur a lot of transaction costs. And if you hold on long enough, when you do finally sell, the share price will have gone up. Sometimes it's just a matter of, did you hold on long enough, right? Because you might have been set to retire right before the Great Recession came and wiped out 40% of your retirement portfolio. I mean, that happened to so many people. So buy and hold just says that the longer the time horizon is for your client, the lower their risk. Don't try to time the market. It is a passive investment strategy. By being passive, it has lower transaction costs. So if you stay in long enough, you will make a profit at some point. Don't guarantee it to your client, though. Of course not. Strategic and tactical asset allocation. Strategic and tactical asset allocation. So there's going to be a question on each of these. They want you to know which one is going to require you to actively manage the portfolio. That's tactical. Tactical has the word act right in it. It requires actively managing the portfolio. So what you're trying to do here is you're trying to time the market. So you're trying to buy low and sell high, but engaging in quantitative analysis, technical analysis, and trying to time the market. So tactical asset allocation involves actively managing the portfolio. You're trying to time the market. Strategic is passive. Strategic asset allocation is passive. So what it does is it says, for example, you're 60% in equity and 40% in bonds. And that's what it is. You're not going to engage in market timing, so you're going to have lower transaction costs in strategic asset allocation. But you are going to have to, every once in a while, rebalance. So strategic asset allocation needs to be rebalanced, because if the stock market goes up and all of a sudden what was 60% is now 75% of the portfolio, you need to sell, because you're probably high anyway, and move some back into bonds. So strategic asset allocation has lower transaction costs. It is a passive form of asset allocation, subject to the need to rebalance periodically, however often it is that your company suggests that you do it. They're all different. The test will usually ask you a question or two on asset classes. Previously in the course, we went over the different types of risks. We said there was unsystematic risk, which is stock-specific risk. That type of risk can be avoided or reduced by diversification. And then there was systematic risk, like market risk and interest rate risk and inflationary risk, that could not be avoided by diversification. However, if you were to diversify by asset class, then if the stock market goes down, the bond market goes up, right? That helps to reduce systematic risk, to diversify by asset class. So an asset class is a group of investments with similar risks and return characteristics. So cash equivalents is an asset class. Those would be money market instruments. Stocks would be an asset class. Fixed income investments, bonds, would be an asset class. Real estate is an asset class. Precious metals is an asset class. Collectibles. So option contracts, calls and puts, we talked about those previously. Calls and puts are a type of an security that has a maximum maturity of 9 months, and that at the end of the 9 months might be totally worthless. So options are not an asset class. The test will use these terms: growth, blue chips, and value stock. So which one of these is the technology company? Probably a growth stock. So technology companies, most of the securities that trade over the counter in the NASDAQ system represent companies that are newer, that if they have any earnings, they keep their earnings. They don't pay out dividends. They have low to no dividends. They keep any earnings that they have to grow their company. So growth stock, technology heavy. The NASDAQ is technology heavy. If you have growth stock, what does it have? High or low PE ratios? Growth stock has high price earnings ratios. Growth stock has what kind of dividends? We already said low dividends. Safe or risky? Growth stock would be risky for your more aggressive investors. What do you think that a growth stock standard deviation is? High. What about its beta factor? High. So a volatile stock price, high standard deviation, and high beta. High beta. So a volatile stock price, high beta. So aggressive choice for your client. When we look at a value stock and we amass a portfolio of value stock, we're looking at the financials and we're buying securities that are undervalued relative to their financials. Value portfolios are going to have low PE ratios as well as low price book ratios. So the book value of the stock comes from the balance sheet of the corporation. So value stocks have low PE and low price book ratios. They also usually have lower beta, lower than growth at least, and lower standard deviation than growth as well. They probably have higher dividends than the growth stock had. Higher dividends on the value stock than you would have had on the growth stock. Blue chip stocks are stocks of well-established and financially sound companies. Most blue chip stocks, not all, but most, trade on the floor of the New York Stock Exchange. Blue chip stocks would have the highest dividend payout ratio of these three. Now, we know dividends are never guaranteed. Dividends are always paid at discretion of the board of directors. The stock price of blue chips would be less volatile than others, so a lower standard deviation. The beta would be close to 1. So moving with the market. So of these three, I would say blue chips has the lowest beta. So close to 1. Not guaranteed that it's always 1, but it's close to 1. Low standard deviation. Low dispersion from the mean. The price tends to move sideways. It's going to have low PE, low standard deviation. So when you see these terms on the test, you will know what they're talking about. Growth, value, and blue chip stocks. If your client is looking for income, bonds are better than stocks. Preferred stocks better than common stock. If they're looking for appreciation, stocks are better than bonds. Value stocks are better than blue chips. Growth would be better than a blue chip for appreciation as well. So you need to determine what is your client's investment objective. Some companies, when you are a corporate shareholder, they'll offer what is called a DRIP. A DRIP stands for a dividend reinvestment plan. So dividends, they can send you out a check, Or you can just let the company keep it, the dividend, if they have such a plan. There's no sales charge. They use the dividend to buy you additional shares. If you enroll in this dividend reinvestment plan, does that mean that you avoid having to pay taxes on the dividend? No, of course not. Dividends are always taxable in the year of the distribution, whether or not you automatically reinvested them or not. It is very important to remember, however, when you reinvest dividends, this would be true on a corporate stock or on a mutual fund share. Reinvested dividends increase the investor's cost basis. But you knew that. Diversification would be a portfolio management technique that would always be advisable. You would never want your client to have all of their stock in one company. Diversification helps us to reduce unsystematic or non-systematic risk, stock-specific risk. Diversification does not eliminate systematic risk. To diversify by asset class helps to reduce systematic risk. Sector rotation is an investment strategy that involves active management combined with a long-term investment approach. Sector rotating is based upon either economic market cycles or calendar cycles, and the idea that some sectors will be up at certain times of the cycles but down at others. To use the sector rotating approach, it must be determined the boom and bust cycles in the sector that is being invested in. So if the sector is in a bust period, what would you do? You would buy, of course. And when the sector recovers and begins to peak in the boom, you would want to sell. Sector rotating requires looking ahead to the next cycle while being fully invested in the current one. Dollar cost averaging is an investment philosophy that you'll read about all the time in mutual fund advertisements.